We're back in 2025 and we are bringing a big live session. Tonight is all about how to grow your property portfolio in 2025. Where are the areas that are set to grow, but also where are the areas that have the potential growth to continue your property portfolio journey? Because what I'm starting to see in the data, and we'll cover a little bit of this, is we're starting to see some markets top out. So yes, they may have some future capital growth to go forward, and 2025 may have them as the winners. But are they actually the best markets to be buying in? Hey everyone, my name is Joe Tucker, and together with Jeff Mars, we created Oz Property Investors, Australia's largest investment community. Each week, we interview top property experts, and this week is no different. We're starting the year off with a bang. We have Jeremy Iannuzzelli of Pradium Partners, an incredible accountant that talks all about the accounting world, but also where he is seeing clients sell their properties. So where are people actually buying, but where are they most importantly selling? Because those people leaving, where are we seeing the opportunity? Then we have Mike Mortlock of MCG Quantity Surveying, and he has got full slides that actually talk to the data. And we will say something crazy, then outrageous, and look at, just letting you know, the 180 days of old listings from WA has dropped 50%, opening up a large supply of value there. So jump into the session, check it out, do the comments, do the like, do the subscribe. You guys know what to do. Let us know your thoughts to this session, and let's jump in. And we are live. Welcome to Oz Property, where we bring the big names and we have the big fun. Welcome, gentlemen. We have Jeremy Iannuzzelli from Pradium Partners, and we have Mike Mortlock from MCG Quantity Surveyors. How are you, gentlemen?
I feel like I'm transitioning to Mike, whoever it is you said. Apart from that, I'm going good. Although transitioning was probably very 23, 24. We're here to talk about the future.
And a bit of the past as well.
Well, yeah, okay, a bit of transitioning. No, we're well, and neither of us are transitioning. Although Jeremy to his new banner, so congrats to him.
Thank you very much, my dear friend. It's it's exciting. We're looking forward to a very big 2025, and there's lots in store for everybody. I think it's going to be a year where you can make some really good decisions. And as the heading says, or it can be very dangerous and poor decisions, depending which level of expertise that you're on or data you're looking at.
Yeah,
great.
Yeah, and that's the biggest thing. I think Jeff is very good at keeping these conversations on a clear path. So I'm going to try my best at doing that. What we're going to cover off today is what happened in 2024. We like to do these prediction things to kind of understand and look back of where did we go, and then what is in store for 2025? Where are the opportunities? Because 2025 is not going to be 2024. In 2023, I think we're fairly comfortable. Like, yeah, actually, it's same. You're going to make a lot of growth. It's going to be very obvious. You're going to throw a dart. You're going to hit it. You're going to hit a goal. 2025 is a very different market. Things are getting very unaffordable, and interest rates are, still up there for people. So unaffordability is high. So it's not as easy as it once was to buy. But anyway, let's not get down on ourselves. It's about where are the opportunities? Where are the opportunities? Where did you want to take this, guys? Let's just...
I reckon what we have is a great opportunity for Mike to really share a large portion of the data, Mike, that you've collected over the last 12 months. Because what people don't get to know about yourself and your business is that you are collecting so much data from where people are buying fairly quickly, which is very rare. Not many people get an opportunity to see the locations that you get to see all around the country, because that's what your business does a lot of reports all around the country. You get to see the purchase prices that people have paid at, settlement dates, and even in terms of the price comparison or price disparity between what they paid for the land and what the actual dwelling is worth. So I suppose I'm going to jump in, Joe. Apologies if I'm stealing a bit of your thunder, but Mike, from your end, what have you seen from the start of 2024 to the end of 2024?
I think we could probably throw 23 and 24 in the same basket in some respects. I describe 2023 as a market that was about affordability, and 2024 is really the same by virtue of the rapid increase in interest rates. Obviously, that diminished the amount that we can borrow, the amount that we can service, and the areas that we can look at. And if you go back to the beginning of 2024, Perth, well, let's say before the Perth run, Perth was the second cheapest median house price of all the capitals and territories after Darwin. Now, I kind of thought, yeah, look, well, let's call it the bottom because no one really invests in Darwin. But then I saw you guys did a live, like, is Darwin the next spot? So
doesn't mean I'm definitely, I'm not. Yeah, I don't want to promote Darwin. We just want to see what's going on there. We want to hear from the people that are boots on the ground. But yes, I'm not buying in Darwin. It's not a place. I think it's a roll the dice type of market. Will you make some money? Hey, let's see.
quite possibly, but I suppose there are certain commentators and certain people that wouldn't have invested in Perth or would never invest in Perth because of its exposure to the resource sector. And we know that, iron ore, for example, is kind of the top of the cycle, and it correlates fairly well with Perth property prices. It's not just that simple. There's a little bit more to it. But yeah, 23, 24 are about the affordable markets. And if you take three of them out of the equation, we're basically kind of like in neutral territory, no growth across the nation. It was Perth, Brisbane, and Adelaide that were the heavy hitters for 2024, and they did a lot of that work in 2023 as well. Now, when we're looking at, let's say, if you look at the final Corelogic print for the December market stuff that I've got here, it's actually on one of my slides as well. You can kind of see that Perth is not really sitting at the bottom anymore. I mean, you've got Hobart at 451,000 as opposed to 813,000 for Perth, and Melbourne. I know you want to talk about Melbourne today, Joe, but we're talking 774 for a median value, which is now cheaper than Brisbane, Adelaide, and Perth. I mean, it's crazy.
I can't believe the median is less than Adelaide.
I know.
Like, how many people are in Adelaide?
I say this all the time about Adelaide, and sorry for anyone that's listening from Adelaide. Last time I checked, there's about a couple million people that live in South Australia itself, not much more than that, of which about 1.6, 1.7 million of those people live in Adelaide. So, by geographical space, by pure square meters and landmass, it is a big state, a very, very big state. And just to see how much it's rapidly moved, I'm shocked. And I saw a huge volume of clients buying there, along with a lot of the lower end of the market properties like Perth and Brisbane. Well, not Brisbane itself, but surrounding major regional satellite cities of Brisbane. So
the beauty of this is what it paints for me is that it's not about price, it's not about population, it's not about how many people live there. It's about the balance of supply and demand. We did a lot of live sessions about 3-4 years ago on South Australia. I've bought a lot of properties in South Australia, and they have done incredibly well because we were looking at the balance of supply and demand, not just because there's 1.2 million people there. So I think that's the key takeaway from that's the key takeaway from 2024 is don't make assumptions. We're talking about Darwin and having a couple of laughs about it, but it is $500,000. It's pretty cheap.
It is cheap. And I was running another research project looking at the different way that house prices respond to different federal governments, Liberal versus Labor, all the way back to the 80s. Why? Well, no social life, I guess. And what I did is I utilized some of the GPT models to analyze different variations and things. And one unintended consequence is comparing Perth to Adelaide. You've got Perth as the most volatile and variable market, peak to trough throughout that historical period of 40 odd years. Adelaide is actually the most sensible. It sort of stays very middle ground. Yeah. So whilst they have certain things in common, they have that very distinct. And you're right,
it's Jeremy, very unique here. 17.3% as you've got in the Corelogic report. That is the largest capital growth they've had for, I don't want to say forever because I don't have the data, but I'm fairly sure since forever.
I've never seen that in the
I can
calendar
tell
year.
you when I started looking really deeply into investment properties before 2010, it was a compressed market for about 8 years prior to that. When I said it did nothing for 20 years, very similar to Hobart, did nothing for 20 years, and then Hobart doubled in the space of 20. One of the observations that I've probably seen over the last 12 to 18 months has been the convergence and a little bit more of the squashing at both ends of the lower market and the top market. So if you kind of break that segment of the market from lower end, say properties under 650, 700 grand, the middle 700 to say 1.2, and that top of 1.2 and above, it's actually been squashed at both ends. The lower markets come up significantly to the point now where it's sitting inside that middle market ground. And the top end of the market, most recently, probably in the last 6 to 9 months, as the full effect of higher interest rates is in the system, we've started to see that come backwards. So it's getting really condensed, almost to the point where now these three circles are very much overlapping with each other, where it hasn't been in the past. It just had it. Lower market was lower, middle was middle, top was top, and there was a very clear separation between each.
Funny you should mention those segmentations, because the next slide, Joe, feeds into my narrative of 23, 24 being all about affordable markets. And you can see in that we're looking at the bottom, middle, and upper quartiles. And I'm on a tiny little screen, but I think it's the poo brown color, for want of another expression. Hopefully everyone's had dinner. But you can see the affordable bottom end of the market has really beaten the middle and the upper basically everywhere. I think there's one example where it's slightly different, but I think it's in the ACT, and everyone's weird there. Big shout out to ACT listeners.
Yeah, ACT.
But I mean, it's a perverted market because, I mean, the city was made, from nothing, right? And then we filled it with public servants who are getting paid a fortune. People sort of forget about that Canberra median price being, traditionally higher than Melbourne. It was always Sydney, Melbourne, and then the rest. Of course, that's not the case anymore, but Canberra was beating Melbourne even at the sort of the top of its game. But yeah, the lower prices really outperformed. Why I think 25 will be a little bit different. And I suppose we should speak to the title of this, because we've sort of said like 2025 would be dangerous, and we're going to be sued if we don't reference that, right? Why I think it's dangerous is because we're off the peak of growth. Now, I want to be careful with the way that I'm putting that. And I think it might even be in the next slide. Like, look at this. This is a well-oiled machine.
He's done
Joe,
it.
if you could just hit
It's like you made it.
Look at that. Yeah, I know. You can actually sort of see there that little downward scoop at the right-hand side. I mean, this is Perth, Adelaide, and Brisbane's growth percentage. It's still in positive. They are still growing, but the peak of growth we are past. We're not past the peak of the market, of course, because it's still going up in median, but it's trending down. So 2025 is not going to be one of those easy ones where we just kind of rode the momentum from 23 into 24. And, you bought anywhere half sensible in those three capital cities, you probably made some money. But now we have to be a little bit more cautious about what's going on. But of course, the big difference in 2025 compared to 2023 and 4 is this looming rate cut, and the markets are about 3/4 pricing that to happen at the first meeting.
So what does this rate cut actually, like, what does a rate cut actually mean for property investing? Like, is it that important?
I'll let Jeremy have that one.
It's rates move different asset classes in very different ways. So rate cuts potentially move the asset class of cash at bank into potentially more tangible assets, things like potentially shares. Well, that one consider that not intangible, not tangible, but properties. So when you don't start to get a good return at cash at bank because of interest rates dropping, that's when you see a huge portion of capital liquidity move into the asset markets that is not cash. So that's one way to look at it. From a property side of things, property is a very slow moving beast. No matter how much velocity is in the market, like we've seen over the last couple of years, it still takes time to get a property prepared for sale, list it, sell it, settle it, and then the next person kind of takes it over. So 12 months is a bit of a rule of thumb for interest rates to really kick in. It's taken 12 months And the pain that we are feeling with interest rates now is because of the last couple of ones we had 12 months ago or just longer. And same goes for interest rates coming down. People actually won't really notice the benefit of interest rates coming down straight away. It takes time for the banks to filter that in. It takes time for them to start to accumulate the savings from the reduced loan repayments that they're making. So this big buffer, this big amount of capital that a large portion of Australians were able to save during the COVID pandemic period, simply due to not spending and lots of liquidity coming into the market, that's pretty much gone for a large percentage of Australians.
We spend it all on real estate.
Well, real estate and cars, the car market went through a crazy boom where people spending top dollar for cars, where now they've lost 30, 40%. It's now they're starting to see their bank accounts low, and that small percentage of Australians who have very fat bank accounts still, this is their time where they're going to prosper quite a bit. So interest rates coming down, there'll be a euphoric moment for a little bit until people start to realize that, hey, that $95 less per month that I'm paying, while that helps, it's not actually making a very noticeable difference just yet. Longer it goes on, more money that you can accumulate, and then that's when you'll start to see the property market react to those lower rates, probably 12 months after those rates start to come down.
I agree with you, Jeremy, there, that it takes a long time for it to wash through the economy. But I mean, that's from a functional purpose. Like, we functionally see it's easier to hold on to this property, or we're going on carrying about our business knowing things are the way they are. But what I think is missing from that is the sentiment. I think as soon as we start that cycle, that's where we will start seeing the sentiment. And really, to categorize 2024, to me, it was a very sentiment-driven market. I mean, we've talked about this off air, just the ability of investment groups and buyers agents and even groups like this to say, okay, well, we're all jazzed up about this particular location. Enough people are actually out there and active and working together or working with certain partners that they can actually kind of move these markets. But outside of that, of course, it feeds into serviceability calculations and borrowing capacity and those sorts of things. So that was kind of where my head was at. But I'm interested in your thoughts on those 2 points.
Well, yeah, one of my thoughts on it is it does drive a lot of sentiment, right? There are a lot of, so this group, right, we've got 78,000. So many people are reaching out to us. I deal with investors all day, and there are a lot of people that are just sat on the fence because of interest rates, because they're scared and they're like, oh, I reckon they might rise, they might go down, they might do. And they just sat on the fence waiting and sitting there. And if you have a look at the difference between property prices and like buyer confidence, like confidence and sentiment, it kind of correlates. Like people that are excited about buying property, it might not be actually affecting their bottom line. Like you say, there's we've got data.
Here we go. I've got
Where's
Melbourne
that
Westpac sentiment data here. Can you see that?
No.
Nah.
Consumer mood has soured.
Worth a shot.
Oh
yeah, I mean that was the latest. That was the latest commentary. So that was the Westpac Melbourne Institute, and the commentary was the consumer mood has soured for 2 months in a row and remains on the pessimistic side. However, consumers expect things to continue to improve from here. So the time to buy a dwelling index has increased 24.9% over the year and 10% over the month. In January 2025, it's 89.9. But a long-term average of 120.1. So it's actually still sort of low.
And it does, and a 0.25% interest rate drop. If you're buying a $500,000 property, a $550,000 property, that's going to allow you to buy now a $565,000 property, right? Like it instantly affects the borrowing ability because the banks are now looking at it. So I don't know if I see but the thing is, there's not going to be a massive, oh my gosh moment as soon as interest rates drop. I don't see that. I don't see that happening, but I do see there being a lot of confidence back in the market where people say, yeah, actually, this is the right decision for me. I've already watched the market go crazy. Mike, just to talk on this point, so what these charts look like is the market's going down, the market's crashing. Like it, what do you draw from this?
Well, that's a rolling 3-month change of dwelling values, and
Right.
it's probably difficult to see on the screen. I probably have here. I have a version right here in front of me. So Perth has actually done 1.9% over the last 3 months. I mean, annualized, that's a rip roaring market, but it's a slower pace than what it was, right? So we've got Perth, Adelaide, and Brisbane. I think you could throw Sydney and Melbourne into the same category in terms of a similar-ish trajectory. But the big three, the pace of growth is down. Adelaide 2.1%, Perth at 1.9%, and Brisbane 1.3%. That's the rolling 3-month change. So why it looks like it's going down is because the pace of growth has slowed, but it's not a market that's actually heading backwards, if that makes sense. It's just a nuance of that way that Corelogic do that.
Sorry, Mike, I'm going to jump in and ask a question, and this is just pulling apart your experience. Where, from a volume perspective, what 3 states have you probably done the most amount of depreciation schedules in the last 12 months?
WA is number 1 by a country mile. When we look back at Q1 2022, it was about 9% of all of our investor transactions happened in that state. So Q1 2022, 9%. You fast forward to Q1 2023, and it was about 33%. It's peaked in our data at over 40% of the tax depreciation schedules we do for property investors happen in the great state of WA that interestingly twice tried to leave Australia, but we didn't let them because that's where all the iron ore is and we need it. We want it. So WA is number 1 by a long way, and Queensland second. And then after that, it would probably still be New South Wales beating the South Australia, but
Really?
it's not necessarily Sydney. I mean, there's a lot of New South Wales regions, but I do have some data on the top SA3 regions across the country on one of the slides, Joe, and also it's been broken down by our analytics team into per state as well, so you can see the top SA3 states. That's actually an interactive thing. You need a web browser for that, but I'd be happy to share that one as well.
Yeah, because it's interesting because that's for me is a bit of a metric. I want to see what's moving the markets. Is it a lot of investors, which typically are looking for results? And again, being in this industry for such a long time, human nature is very fickle. Once they start to see, markets flatten, Joe, for 2, 3, 4 years, they tend to get very impatient. And I have this saying all the time, and it's not, and this is why I say 2025 is dangerous. Dangerous is as everyone went into the market together, believe it or not, they all exit together.
Are you seeing that? Because the beauty of you, Jeremy, is you've got the insights into, hey, should I buy this property? Because I need to get my trust created. You're being an accountant. So Jeremy Iannuzzelli is an accountant. Do I need to get this trust set up? Should I buy this property? What are your thoughts from a financial standpoint? Does it help me? But then also, when should I sell my property? Jeremy, I just made $300,000. Do I think the Perth market is going to make that continue that trend? Well, probably not. Should I sell? Like, what are you seeing on the ground?
So I having the conversation the other day with many people, it was just what I saw was a lot of people bought into these markets in late 2021, in 2022, and I'm talking about those 3 beautiful states that you saw on those charts, which are leading the way. Again, driven by the affordability, and they did very well. But when they look at the numbers of 2022 and 2023, interest rates were very kind to them. These properties were maybe cost them a little money, Mike and Joe, or nothing. They're actually putting money sometimes in people's back pockets. Fast forward to 2024, especially towards the later end, October onwards, these properties were all costing them anywhere between $250 upwards of $350 a week. Properties which were, a couple grand positive or slightly neutral, slightly negative, to now being over $15,000 a year. Those clients are starting to say, hey, I've made double my money in the space of 3 years. if properties revert back to their historical mean, which could be the 5, 6, 7% return, and I've made 100% return in 4 years, that's 25% per annum, or 100% return in 3 years, that's 33.33% per annum. Well, what's in store for me moving forward? Are things going to kind of slow down or stagnate so the property has time to catch back up to its historical average, otherwise called reversion back to the mean?
No one wants to talk about that, you know.
I'm sorry, we don't want to, but this is again for our 2025, is that these properties now are starting to cost $15,000, $16,000, $17,000 a year. Their mortgage, their buffers are starting to dwindle away, and the cost of living, that rising cost of living, start to pinch. So their mindset is, hey, why am I keeping something that is costing me 15 grand a year when I've doubled my money? So that back end of 2024, Mike and Joe, I was probably talking to more people and doing more capital gain tax provision calculations than I've ever done in my nearly 17-year career.
Interesting.
Jesus.
That's very
ever done in my 17
in your
career.
entire career. And were they in these, I mean, you obviously can't give personal situations, but these are the SA3s that your data has been looking at, Mike, for the so actually tell me, what is this?
I'll tell you exactly what it is, Joe. Yeah. So when people come to us, they say, Mike, I've got an investment property and I want to know if it's worthwhile getting a tax depreciation schedule. Obviously, we first check that it is. And if it is, we do it for them. And what people have sort of got confused in the past is I've shared data before saying, you know, like 40% of people are buying units, and then people attack me in the comments. Why are you telling people to buy units? I'm like, I'm not telling people to buy anything. I'm just doing what they bring to me. Now, they can bring what I think is a great quality asset, or they can bring garbage. It's like a Hippocratic oath. I'm sort of obliged to do my best job with whatever they bring me. So this is not an endorsement of where I think the best hotspots are, although some of these points I think have still got a hell of a long way to go. But these are the top regions for 2024 that we saw by investor transaction numbers broken up per statistical area 3 across the country. So even though I said WA was the number 1 state, Townsville was the number 1 SA3 region.
And I probably saw from a purchasing perspective on my end, Mike, a lot of properties being purchased, and that shift from Perth into that northern part or the far north Queensland area, because of and driven by purchase prices. I think at that stage I was seeing purchase prices sit between high 3s, or by memory is the cheapest, and probably mid 5s. And that's a really good sweet spot for many property investors who want to get their toes in there, but not necessarily take a very big risk for something they potentially can't afford if, you know, things like, you know, tenant vacancies become an issue. But I very rarely saw clients, again, compared to 2021 and 22, purchasing in that, say, $800,000-$900,000 or above bracket. In 2021 and 2022, Joe and Mike, I'd probably say half of the purchases my clients are making were with an 8 and 9 in front of it.
Interesting.
So, yeah, absolutely. Interest rates were low, and you know, deposit requirements probably weren't as high because a lot of the liquidity that the government forced the banks to do through the bond buying program. So that was where a large portion of the Gold Coast benefited from that. A lot of people buying in those beautiful Gold Coast areas where the prices were 8, 9, and they skyrocketed very quickly to mid 1s very quickly.
So are you seeing this slow down, Mike? Like, I mean, we've got Townsville, Gladstone, Midwest WA. I'm not sure where Midwest WA, Rockingham, Mandurah, Wanneroo, Rockhampton, Bunbury, Toowoomba. Are you seeing a slowdown in these markets, or is this still a pace that's doing quite well?
I don't have that data to hand, Joe, but anecdotally, just by, you know, taking the pulse of what we sort of see coming through the door, Townsville, I know for certain is still very, very popular, as are places like Toowoomba, for example, which is kind of midway down the list. WA, I don't know about the SA3 regions in terms of which are coming up and down. We have the data, we just didn't slice it tonight. I mean, I thought you'd be happy with the 14 odd slides It's real glass
I
half
think that's
full.
20 now. You've really
20,
outdone yourself.
But,
Don't know how
if
many
you
you
had
put
to,
together.
make a general consensus, Mike, what would you say? A general
WA is still number one in terms of transaction volumes. But yeah, look, I think I don't have the data on the SA3, but there's nothing that sort of points to me in a slowdown in areas like Townsville or Greater Perth yet.
Yeah, I definitely. Yeah, I mean, not that we're making predictions just yet, but the Townsville markets, the WA markets, I still think are going to surge quite nicely. The biggest challenge that you've got in WA now is affordability, right? We were buying properties that were $500,000 that are now $850,000. The people that live there can afford $800,000, but they can't really afford 900, a million, and 1.2, 1.3, 1.5. Like, it just can't continue at those crazy growth rates. As much as I would love it to, it's just reality. You can't continue to just keep doubling. But also it comes down to an affordability aspect. That's why I think Townsville and Gladstone have done so well, is they're so affordable, and the rental yield is amazing, right? 6.5, 6. It's probably now down to about 5.2, 5%, which is getting pretty interesting. But I still think there's a little bit of steam in those markets. And property is like a big ship, right? It doesn't just turn all of a sudden. It takes time, and the data will eventually get you there. It doesn't just lights on, lights off.
My challenge with looking at Townsville and Gladstone, again, seeing that over many years, and we're going back now 2009, 2010, I saw that area double within 2 years. And then I saw that area drop by about 2012 by 50%, vacancies 30%, rents dropped from $450 a week to $200 a week. And then what those areas have been doing for the last 10 years is had very little or minimal price growth, but the rents have kind of been climbing with inflation every year. So then you get this beautiful scenario where you've got yields at 6, 7, sometimes even 8%. And that's when you start to see the investors come in to snap up these really good yields, and more follow behind. The question is where does that infraction point then start to begin of, hey, like Joe said, these people just can't afford any higher prices, or the rents just can't go up anymore. And that's when you start to get yield compression, and then it doesn't look like a desirable investment area anymore.
Well, I mean, yields have been smashed the last little while in, Perth, Adelaide and Brisbane, just by virtue of the capital growth, right? But like you were sort of saying, Joe, like, people can only afford to spend, 800, 900. I think we are definitely now seeing that in the data from a rents point of view. I think rents are much more exposed to the cost of living pressures than house prices would be, because we're definitely seeing a change in, I think it'll take some time to hit the ABS, but in the household formation rate, because median rents in Perth aren't going to get to $1,800 a week, because nobody can actually afford to do that. What they'll do is they'll reach some sort of it'll reach some sort of ceiling, and then people will just change their behavior because they're priced out of it. If they got the option to stay with their folks for longer, they will. They'll bring in a roommate, or they'll join a share house. I think Cameron Cusher said this at the Pippa breakfast in Brisbane last year. REA own the site flatmates.com.au, and their target market was probably a younger, slightly more handsome version of you, Joe. Though you are handsome, but I'm just thinking, like a uni student in the peak of his career. I mean, you've just had a baby. You can't necessarily be peaking and be filling the house with love. What they're actually doing is they're changing the whole marketing model to not be looking at people like yourself, uni students, young effervescent people. They're changing the marketing to be middle-aged women, because they're finding those are more likely to be the users of the site than the uni students of old. I actually think that's a terrible problem with society, that's the situation that these women are finding themselves in. But with crisis levels of rental accommodation and the government really out to lunch in terms of fulfilling their responsibilities, that's kind of what's happening. So we're definitely seeing a change in that behavior.
Well, I mean, if we just look at your vacancy rate chart that you've kindly, very graciously, I accept it with wholeheartedly, the amazing chart that you've created. Oh, did you create this chart, Mike?
Cut and pasted it from Louis Chris for this one, actually.
Right, okay. All right,
Big
right.
shout out to Louis. Love your work. Probably should have his logo. It actually says MCG research on the bottom of that. That's on every page, but this is SQM. I'm pretty sure you can tell by the shade of blue, but no, this is SQM vacancy rates. Go on, Joe.
Well, no, I guess that's kind of looking at it. Vacancy rates for 2024, November 2024, vacancy and vacancy. Oh, their numbers and the percentage, right?
Numbers, yeah.
Is 1.4% national vacancy rates. Nothing except for Melbourne under 2%. Nothing below. There's one at 2%. The rest is below that. I totally agree with you. I don't see this trend changing very much. Vacancy rates are based again on the supply and demand, and we're just not building enough houses.
Those trends seem to be going up for the three top, Sydney, Melbourne, and Brisbane. If you look at November of 23 versus November of 24, mind you, immaterial, but you can see there number of vacancies in Sydney, for argument's sake, in a year rose by about 3,000 dwellings. Melbourne significantly about 4,000 dwellings, and Brisbane only a very small amount by about 500 dwellings. So there's starting to be, if it follows, it starts to gather momentum. But again, I think you'll find that would probably correlate back to a significant level of migration that we had in 2023 and 24, which we all tend to not talk about for some reason. It doesn't hit the media as much compared to, say, 2025, where those migration numbers and the intake levels are drastically going to be reduced because we've got an election year coming up. And that's been on the tip of everybody's tongue about the number of migrants absorbing a large portion of the dwellings here in Australia.
Love a bit of xenophobia in Australia, don't we? It's those bloody immigrants that are ruining everything.
Peter Dutton's back in a whole, I don't want to talk about too much about politics, but he's back in a whole campaign off the back of patriotism that Donald Trump ran in the 2024 US election. So it just happens to be that might have a tangible impact on vacancy rates, Joe and Mike, in 2025, that number of migrants coming into the country, that intake.
Well, I think we first saw a decrease in the December quarter of 2023 because it was, that was probably the peak, right? And I think that's where it really was in the media. And then we kind of saw, okay, well, the government's done something about it. They have sort of forgotten about it, but it's still an issue, right? I mean, we do actually need that.
3% is a balanced market, so we're at 1.4.
We're still very low. We're still very low. We're still very low, and that could be because of the Airbnb market. Mind you, those new taxes come in very soon. I think, or may have come in already in Victoria, the vacancy tax. So that's going to change some habits for people that may have been using their property for the Airbnb market in Victoria. So there's probably some catalysts there for movement. Again, all depending on policies that's going to be announced in the 2025 budget as well.
Yeah, I think that the availability, it looks like the affordability is going to hit from a vacancy, like what you were talking about, that no people can't afford to keep pushing the prices up, but still there's going to be a lot of people intake. So you're not going to get, it's not going to go from $500 to $600 a week. It's going to go from, $500 and $550. It's going to stay at $550. You'll be able to get it, but it's just not going to see the crazy rental price growth that we've seen over the past 3 years.
Yeah. And I
think we've hit our head on the roof.
Yeah, off the back of what Mike said about the number of people in an average household size, in 1988, there was an average of 3 people per household. And believe it or not, that bottomed out in 2023 to 2.44 people per household. But now it's starting for the first time, starting to actually tick back up in the opposite direction, heading back up to 2.5, 2.6 people per household. So the dynamic is all changing again. It's again cost of living and price pressure, which is driving people in different directions, because we've had interest rates coming down for the last 12, 13, 14 years, since probably 2010, 2011. So it's given people that freedom, that sentiment to be able to take a leap out, maybe go rent or buy a home.
What I think specifically people need to understand about immigration's influence on the rental market as well is that we know from the data that immigrants much more likely to rent and somewhere for around about 5 years before they purchase, which completely makes sense. I mean, imagine moving to a whole new country and going, I'm going to buy this little slice. You don't know anything. You don't know where's where. You don't know where the good restaurants are. You know, you don't know where to get your hipster haircuts or whatever people spend their money on. I don't go outside very often, but it has a huge influence on the rental market and perhaps a lot less to capital growth than it has for a long time, because it's not an environment that is conducive to overseas investors at the moment.
Yeah, and I guess all of these things kind of spell opportunity, right? Like, I guess from a rental side of things, there has been a reduction of household sizes, and we're now starting to see a little tick up due to the affordability. But that's a general overall, but not. There are then other markets where that is continuing to drop, and then there's rental stock, right? There are areas where rental properties are drying up because investors are leaving. And it's like, okay, great. Well, the investors have now left. Oh, now rents are continuing to grow. Exactly what we've seen, like in 2024. There are still opportunities in many markets, and that's why I don't like charts like I'll just bring it up again, like this, where it's like, oh my gosh, this is no, it's gone. What was the capital growth? 4.9 annual capital growth is 4.9%, and then the total return is 8.9%. The markets that have excelled at that have done far better, 22, 30% capital growth. Like our average, I went through the data on the properties that I've purchased over the past 12 months. In the past from 6 months ago to 12 months, we had a 27% capital growth annualized. And yeah, sorry, not annualized, from 6 to 12 months, all of the properties divided by, and 27. For the 12 months, we had 22%. And then the property market's only risen 5%. So I guess when you see charts as like new investors, you see charts like this, don't let it scare you, because the goal here is to pick the eyes out of it and trying to find the markets that have the best capital growth based on what's happening and what's going on in those particular markets.
Well, you can't invest in the market or the Melbourne, can you? Right? You've got to pick a place.
It's just so interesting when people talk about history doesn't repeat, but it often rhymes. I remember looking at WA when it did beat Victoria, and it did beat a number of other areas. And then all of a sudden, a couple of areas like Canberra at that stage, but again, that was a Labor government that first got into power when Kevin Rudd was in there. But I then just remember this ride that Victoria had, and it was getting 20% growth year on year on year, and it rode double digits almost all the way probably to about 2016, 17, and then Royal Commission kind of bursted its bubble. But it was surpassing Sydney for a decade in terms of average annual growth being higher. And probably a decade, it was actually the best performing state year on year for 10 years. It's just so interesting to see where it was 15, 20 years ago and where it is now, and just how much that's repeated itself during the last boom that WA had back in 2007, 2008.
It's going to be interesting.
It's going to be a wild ride.
Lead into our predictions for 2025, but I think we've got a couple of more points to hit on. What are we looking at here, Mike? Because you've got investor activity, right? Everyone's like, oh, the median house price for New South Wales is 1.19, and then you've got the average purchase price being 668 for New South Wales. What are we looking at
here? Where is that, Mike? Where are people averagely? Is that units that are bringing that average down?
No, it's across the board. This is houses and units, but yeah, this is the average purchase price people are spending per state where they're buying. So houses and units will skew it, because in our data we actually we've seen more unit purchases in the ACT than we have houses, and typically there's a chance they will be more expensive, even because they're likely to be newer, well located. It's not an exact science, but in places like WA, I think it's about only 7% of unit purchases rather than houses. But yeah, this is the average that people are spending. And across Australia, 659K, just to give a bit of context to what the average people are paying.
And New South Wales, sorry, I need to know for myself, are you predominantly seeing units that people are purchasing in this data? I know you said it's a bit skewed, but is it units or is it regional that you're seeing a lot of New South Wales?
No, it's regional. You're right, because you can't buy anywhere in Sydney for 668,000 units. I have the data, but I haven't put it on the slide. Across Australia, people are actually. I do have this. It's the next slide, Joe. House versus units purchases per state on the next one. There you go. So in New South Wales, 54.8% of purchases were houses, 33.9. Now that doesn't add up to 100, because we've got granny flats and duplexes and all sorts of weird different things. But that gives you a bit of a breakdown. So 82% of investors are buying houses, as distinct from 11.9% of investors across Australia buying units. And I've seen that as high as 50-50 in a financial year before. I'm actually quite glad that investors are choosing houses rather than units, especially if they're not the older style bulletproof ones.
What about the shift to affordability? Are you starting to see people be more attracted to the yields that units provides and become more of affordable assets?
Only anecdotally. I've done a couple of podcasts with people talking about the price differential between houses and units, and in places like Sydney and Brisbane. Let's say blue chip places in Brisbane. In some locations, there's $1 million price disparity between a house and a unit. Yeah, of course, you're getting more, but there is a tremendous amount of pull for people to come into a community to purchase a unit, to be in and around, the houses and the beautiful location in the area for $1 million less spend. So I'm seeing anecdotally people are taking advantages of that, but it's not sort of entering the data where we're seeing a meaningful uptick in the amount of people buying units. I think historically, as far as our data goes, it's at a low point. I don't think we've ever seen it under 9%, for example. So it does make sense. I mean, if there are still affordability constraints, then people may choose units rather than houses for a cheaper price point. But I think rather than that, there's still probably opportunities in regions to get houses for a cheaper price, especially if they believe in the local fundamentals.
And I suppose what this also tells you as well, two things. Number one, from a client perspective, I don't think I've seen a client buy an investment property that is a unit for the last 12 months. And I could probably openly say that I haven't seen any clients buy, from an investment perspective, a unit. A couple buy homes that they want to live in from a lifestyle perspective, but not investments. But what that also tells me is that developers are looking at that data, and they're noting, and that's why there's a substantial amount of units that are still sitting as stamped, planned, ready to go, but haven't been built. And I know of many very large developers that are holding off on 30, 40, and $50 million developments because they just haven't got a target market to sell to. And that means that there could be, and again, maybe a positive thing, a bit of silver lining, is there could be this little bit of green patch that may arise for units probably being a little bit undervalued while stock levels might be relatively low. And then if you're smart enough to swing that transaction, and no one's going to be able to tell you the bottom and the top, but one would probably say that units will have their time in the sun. May not be forever, because as soon as they do start to become, again, profitable, that's when you see developers who already have buildings and plants ready to go. So we're not lagging 2 years for them to construct. They're ready to go and have it been built in 18 months. That's when you might want to say, well, okay, I'm ready to take advantage of the money that I've made and I'll move that on to maybe a house. So there is some opportunity there if you're willing to treat property as a business and get the right level of education to know when to get in and get out, and almost treat it like a trading stock rather than a very long-term investment.
Yeah. And do you typically see people doing that successfully, or is that just a very sophisticated game that people play?
Probably not successfully. I will though say I remember seeing a large number of clients in about 2013, 14 buying 10 units off the plan. 10 units off the plan and doing simultaneous settlements on those 10 units in, say, 2 years' time, 2016, and making millions of dollars, millions. And it was just awash with money. And these people were trying to tell me to get involved. And I said, guys, so you've got to be careful. You've got to be able to make sure that you can fund and settle these properties, because if the door comes knocking, they've got to get paid. And then lo and behold, banking roll commission comes, and those people won 3 or 4 times, but then lost it all on that 5th one during the roll commission. So if you're smart enough and you know when to kind of exit and throw your cards on the table and walk out of the poker game, there's a lot of money was getting washed around in those heydays of just people buying and signing a contract and making 300 grand by the time the land was developed or the unit building was built.
Okay.
Just picture Jeff singing The Gambler, as the soundtrack to this. Got to know when to hold them. That's right.
Well, one of the big things I think that you'll be seeing in the data, Mike, is average distance in between residents of investment property. So what is this talking to, and have you seen a shift over time?
Have we seen a shift? Yes. Jeremy's sort of referenced in the beginning just the data that we see, and I love it. Really, I started a tax depreciation division just so I got data to look at and share with you guys, to be honest. So there's certain data points that we get that even Corelogic won't have. For example, the first time we ever released data on the percentage of people that live in a property before turning it into an investment property, I'd never seen that before anywhere else. And we found that figure floats between 22 and 25% of all residential tax depreciation schedules that we've done has had someone own or occupy that property from the beginning, which is way higher than we expected, because we need to know that information to maximize the depreciation deductions. Now, Corelogic presumably won't have the address of the people that are buying this investment property, but we do. Of course, we don't share the address, but we can do our own internal analysis to look at, well, how far from where their actual residential address is or their postal address is to their investment property location. So we can split this two ways. The way that we've sort of done it here is the distance between people who live in New Zealand and they're in, New South Wales. The distance between.
No,
I just went to New Zealand, so stuck in my head. Marvelous place. The distance people from New South Wales that live in New South Wales from where their investment property is 2,228 kilometres, and the Australian total is 2,049. And have we seen a change? We were the first to release this data, as far as I'm aware, and we did that in 2019, and we saw the average was 293.47 kilometres, and that was way higher than I thought it would be. I mean, if you segment that down, you could say, okay, well, 60.1% of people, I've actually got it pinned to my door here because I left it there from doing the media when we first did it, but 60% of people at that time bought within 50 Ks of where they live. But what we were sort of trying to get at is, are people inspecting these properties? So, for example, if you're buying more than 1,000 kilometres, in 2009, you were 7.7% of investors. More than 200 kilometres, you were 29.5%. So you could probably say, roughly a third of people were buying properties either sight unseen or with a buyer's agent. So starting from 293, we then saw, and that was pre-COVID. Then when COVID happened, we saw in the first year, we saw it reach the 500s, and then we saw it reach the 800s. And then the last time we published the data, it was 1,500 kilometres. So this is fresh data of every transaction in 2024. It actually increased. Now, 1,500 surprised me, and I'm pretty sure I said to journalists, it won't go any higher. Hopefully none of them are listening, because I thought that was just the story of Perth, right? Like, because Perth is so many bloody kilometers away, and most property investors live in that tiny little slither of East Coast that we've got, Brisbane, Sydney, Melbourne, those sorts of areas. So I kind of thought it was 1,500 kilometers because of the rise of Perth. And I thought, well, you can't really get much further away in Australia than Perth. So I expected that number to come down. And I suppose I didn't expect Perth to run as long as it has. So 2,000 kilometers. I mean, you can see Northern Territory, people are buying 3,500 kilometers from where they live, because even Northern Territorians don't believe in their local property market. But yeah, across the board, 2,000.
To put that in perspective for anyone that's listening, because 2,000 Ks, okay, well, how far is that? Sydney the centre of Sydney, you drive from the Harbour Bridge to the Adelaide Oval, you are driving 1,375 kilometres.
Oh, wow.
Which is about 15 hours and 4 minutes. And I'm putting this into where it is, so I'm pretty sure that it's accurate.
Yep.
So if the average...
With Townsville, Jez, actually, you'll probably find it'll be very close.
Well, Sydney, so Harbour Bridge to the Margaret River in Perth is approximately 3,800 kilometres.
There you go.
So if we look at then Sydney to Townsville while driving, that's 2,077 kilometres. So you're bang spot on. For anyone that's listening, people in Sydney, for argument's sake, there you go. People in Sydney, for argument's sake, they are investing on average the distance from the Harbour Bridge to the centre of Townsville, which from a driving perspective in the car, you'd be enjoying your family and your kids for 22 hours and 43 minutes.
If enjoying is the word that you want.
But that's such an interesting slide, because again, I love using history. Again, starting in the industry a long time ago, people from Sydney bought properties in Sydney. This was before realestate.com. This was when you looked in the newspaper to buy properties. That's when I started buying properties. People from Queensland bought in Queensland, because when I had Queensland clients, they'd have 10 properties in Queensland. Victorian clients, 10 properties in Victoria. Now, I have never seen a more diverse portfolio, apart from the last couple of years with a significant concentration in WA, but I've got clients all over Australia and I've got clients all over the world with a very diverse portfolio of having multiple properties in multiple states at the same time. So that's a big shift in 16, 17 years.
I want to shift gears. I'm over the past. We cannot do anything about it. It's done. It's done. I want to get out the crystal ball. And I was thinking about this today. Is it a crystal ball? Like, if you can start to see the flows and trends of data, is it like looking into a crystal ball? Like the only analogy that I could come up with is kind of like when you've got a busy traffic day and you know the ways around the local traffic. So this place doesn't back up, this place doesn't back up, because you can start to look ahead and say, actually, I know that interest rates will do this, supply will do this, demand is going to happen here, because I can see that the inflowing is going to do that. It does become, takes a lot of time, energy, and effort to do it, but it doesn't become a crystal ball prediction. So I'm going to jump to our ad, and then I want to talk to what are the 2025 predictions, how are things going to look, and how is that going to shape our buying opportunities for the year. Let's do it. The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yield, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you.
With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia, and not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
There we go. Let's talk about it. Where are we going to go in 2025? And Mike Mortlock, you have provided a wonderful little slide here that talks to the things that are on everybody's lips. Interest rate cuts.
Oh yes, my screen's too small.
A little bit.
Yeah. Well, I think that's the big difference between 2025 and 2023 and 4 is that we almost certainly will get a rate cut. This isn't live, is it? I've said that now. Something's going to happen. Yeah, because the US dollar's doing so well that's a cause for concern. That if our dollar's so cheap, it can be quite inflationary for goods and services. And you can actually see that in the GDP print with agriculture and fishing and mining. I think it's the only one that went absolutely bananas the last time, but we are probably going to get a rate cut. So if you look at the trading day, 30th December, there was a 67% consensus that we would decrease at the next meeting. And then from the day after, it went to 73%. On the 8th of January, I don't know exactly what happened, but it went up to 78 for a bit. And I think we're back down at 73% from 2 days ago. Of course, that's going to have that's going to make a difference. And I think the election has to be, Jeremy, does that have to be by May 18th or thereabouts?
Well, he'll call. Yeah, it'll be something that he has to call it by then, but not necessarily does it have to be by then.
Yeah, right.
But Michelle will be keeping her ears open for that because she doesn't want to. This is Michelle Bullock, the Reserve Bank Governor of Australia. She doesn't want to be playing favourites, and the RBA do go into their shell a bit and do remain quite coy, especially in election years. So it's interesting because you saw Westpac and ANZ, I believe, talk quite heavily around interest rate cut rhetoric. A couple of banks said probably not, and all of a sudden now we're starting to see a couple of them backtrack. So I wouldn't be surprised if that percentage starts to drop further and further as we get closer to the meeting in February, mid-February, I think it is.
Well, I was looking at the predictions for the banks, and CBA has it pinned for February at 3.35 by December 2025. Westpac has it at a May drop at 3.35 by the end of December. And then NAB has it in May, and then ANZ has it in May. So CBA is the only one that believes it's going to be in February, and the rest believe it's going to be in May.
You've got to have the vested interest from CBA holding the largest amount of residential loans in Australia. But in the two-horse race, always back the one with self-interest, 100%.
Yeah. But I tell you what, if there is a February rate cut, how many seconds before Labor call the election? Because they're going to want to run with the wind in their sails from something like that if it happens, right?
Yeah, absolutely, and that's why, as I've said, quite openly, the last time a rate cut happened prior to the election, believe it or not, was when rates really used to move. It was the election that John Howard and Kevin Rudd had in 2007. The election, by memory, was in June. And the RBA raised the interest rates from 6% to 7% in May of 2007. And John Howard, to this day, in all of his memoirs, says that was what lost him the election.
Well, you remember the good old days of 100 basis points?
That was when rates moved. They moved at 100 basis points at a time, 50 basis points. None of this 0.1, 0.25 death by 1,000 cuts. You want something to happen, you raise the rates and you hammer it down. And you want your economy to do well, you drop the rates like what they did in COVID, slashing rates at 0.75%. And we saw how quickly the market reacted to it. So it is a slow moving beast, but it's a slow moving beast because the politicians and the bureaucrats involved make it that way. So no one wants to be heralded as the person who smashed the economy.
I think I'll throw in my 2 cents and then I'll let you guys tear it to shreds. I think the property market will be somewhat similar from a national growth perspective next year. I don't see any fundamental changes. I think the elephant in the room of rates will have an impact on sentiment, but we're not going to see interest rates 2% lower by the end of the year, right? So it's still going to be about affordable markets. And we're looking at markets like Perth now coming from second last to right up there. People are going to have to look further afield to be able to transact for sub $700,000. So I still think it will be about affordability, but it won't be a bit necessarily as much about affordable capital city markets because there aren't any apart from Darwin and Hobart. Will this sort of see Hobart's resurgence? I think there's still a few issues with stock levels in Hobart. I do actually think it's due for a rebound, but it's probably going to be late 25, early 26 for me. I still think we're going to see some movement in Perth, Adelaide and Brisbane, but I'd be expecting it to be at least sort of half the pace of what it has been. But the real movers, the boom locations, I think are going to be those regional locations that are just supported by good affordability metrics, good infrastructure pipelines and great employment opportunities. Some examples of those could be along the Inland Rail, where we've got places like Albury, Toowoomba. We've obviously seen a lot of people investing in our data in Toowoomba, and there's still some affordability there. But I do think that some of those North Queensland markets, like the Townsville, like the Gladstones and like Mackay. Now, they're not all the same just because they've got a nice climate. They've got a lot of different things going for them. And I think, Townsville is probably the pick for me in terms of the diversification of the local economy. That's probably the best I can do for someone that doesn't spend their head, looking at the days on markets and vendor discounting and that stuff day in, day out like you do, Joe.
Yeah, well, it's just kind of looking at it from a macro perspective, and I think you're spot on. We have a serviceability problem. We have a borrowing ability problem. We are not going to be able to go out there and buy a $1.5 million asset. So those are the markets that are not going to continue to go up. The bottom, I like what we brought up here before, was talking about the top quartile and the bottom quartile of the property market. And I think that some people just need to, as investors, we have to realize that this bottom quartile is now not $300,000. It is now $550,000, $650,000 is the lower quartile of the market. But we are absolutely going to be hemmed by, in 2025, our borrowing ability and serviceability. So those affordable markets are 100% going to drive. And also the affordability from a cash outlay perspective. The places that have good solid yields are going to do quite well as well. What I would be focusing on the most as an investor, and Jeremy, you love talking about this, is net yields after all is said and done, right? So some of these regional places have high insurance and they also have high council rates and
high repairs and maintenance as well. I think a lot of people forget that being in these very climatic conditions and very vast climatic conditions, that increases your general wear and tear on the property. So that's, sorry, Joe, to interrupt. Apologies.
Yeah, mate. No, it's spot on, because that's your net outgoings, right? The biggest thing I think for 2025 for me is supply. That's what you should be looking at, right? Demand is one of those things that kind of fluctuates and can kind of change. Supply is set, and focus on the areas that have limited supply coming on, because that's what takes 2 years to kind of come online. It's that balance of supply and demand that drives capital growth. So if you can buy an area that has low supply coming onto the market, that's super affordable, and then buyers can afford to buy there, that's going to be the best spots for you?
I'd probably say, again, I go back to that compression that we're seeing on both ends of the property spectrum, the top end and the bottom end, really compressing. And what that means is that when you start to now compare properties and compare regions, like comparing a property in a regional area for $650,000 versus comparing a property 20 k's away from Melbourne CBD for $650,000, then you now need to start to weigh up, well, where do you see, again, we talk about supply, those supply constraints happening. That's number one. And that's what I think people are now starting to cotton on. It's about value. If I go spend $600,000 on a cheap price property because it's gone up so much, how about if I increase that spend to $700,000? Am I getting maybe $900,000 of value for spending $700,000 as opposed to spending $600,000 and maybe only getting $550,000 worth of value? Because that's that cheap property market really rising quite quickly. So I'm starting to see clients have that comparing mindset. Hey, Jeremy, this is the property that I found. It's for 620. But if I'm going to, let's say, parts of Victoria, for argument's sake, or, a little bit more regional areas, south coast, north coast of New South Wales, or, maybe some 30 k's out, 25 k's out of Adelaide CBD, I'm getting a property at the same price in better quality, better condition, maybe slightly less rent, but it's the same price as purchase. And I'm not going 1,000 or 1,500 k's away from, say, Brisbane CBD or from Perth CBD, for argument's sake. So I think from my end, comparison is going to be what people are going to start talking about. I'm buying this, but I'm comparing it with that, and that actually presents better value. I'm seeing a movement from a sell perspective. I am still seeing a lot more clients now talk about selling as opposed to purchasing. And as I said at the start, a lot of people who buy together will also sell together because they all need to move their money. Move their money into different areas for that growth.
Isn't that a terrifying prospect, Jeremy, for places like Perth? For example, you could see thousands of listings a month from investors that have, 50x or 100x their money. It's almost to the point where knowledge of the State Residential Tenancies Act is of value because, are people going to want to sell mid-tenancy? Can they vacate a tenant to sell the property? It differs from state to state, but that's kind of where my head is at, because if there aren't that many impediments to removing people from the residential tenancy, then you could see a huge exodus of people that have made money in Perth and are just looking for greener pastures.
Greener pastures, or again, buffers are starting to dwindle away, or the metrics of the property have changed. I think that's very important to understand, is that the opposites happened on two ends of the economy spectrum. We had high liquidity, so substantial amount of money being lent in the market, combined with low interest rates. That is a perfect storm for all assets to substantially grow. On the other side, we're having now a lower amount of liquidity, which means people have less savings in their hand, less capital to play with, and higher interest rates, which is hampering borrowing capacity, which is an environment for potentially people to start to feel the pinch and maybe sell. Now, I don't think selling's happening at the velocity where it's anything bad or panic stations, but it trends, and as it starts to build momentum, Mike, and go down that hill, it starts to capture more and more people with it. So, it could be a dangerous year for people that bought in very heavily investor-dominated areas. If 80% of the properties in that space are investment properties, you've got to be very wary, because when properties come to the market, or the average time of holding properties in that market is quite low, well, then that's a factor that can represent price fluctuations up or down.
It is.
So it's a dangerous thing. 2025.
It scares me a lot, and I talked about it a little bit in the beginning of Perth, and nobody really wanted to hear that. They just sort of thought, like, who's this guy saying naughty things about the place that I bought in and is definitely going to go up 8,000%. my concern was there has to be a ceiling of that market. And let's have a look back at history. We know for a fact that there was a 14-year period where the median house price in Perth did absolutely nothing. So my concern for people was to be buying at the peak of that market and then perhaps having a decade of no growth with the property that might be negatively geared that they're having to service. That was a concern. And I think we talked about 2024 being about fever pitch and about sentiment. I saw a post, it might not have been on this forum, but it was Terry Ryder talking about Perth. And I think he was sort of saying, you know, fundamentally, we're seeing the peak of the market. And someone put a picture of him and wrote, "Who's this geezer?" And I thought, come on, like, whether you like Terry or not, I actually think he's a lovely chap. You can't discount the decades that he's spent as one of Australia's, you know, premier property researchers. Whether you agree with him or not, he's not just a geezer, right?
That's it. But I think what we will see, again, opinion, and that's because I've got the luxury of having lots and lots of people that are investors. I am starting to see, again, Mike, you're going to kill me when I say this, I'm seeing more transactions occurring in Northern Territory from a purchase perspective and Victoria from a purchase perspective, from an investment point of view, than any other states in the country.
Interesting.
I just wanted to touch on what's going on in the background here to give context. This is the capital growth of properties over the 19th. So you can see the year at the bottom here, 1989. We've been talking about, these regional markets doing incredibly strong for 2024. WA is going to continue to go strong. That does not mean you should buy an investment property in these markets right now. This is what's going to happen in 12 months' time. But, the Oz property portfolio, we just invested close to $3 million in Oz property. And the majority of that, outside of one purchase, has been spent in Victoria, because we want to ride the capital growth train, and we want to be a part of this little moment here when Melbourne
Wait to see Perth. Sorry to interrupt. You're going to see Perth really raw. This is when it really raw. This was the peak of the mining boom. This is when iron ore was getting up to about $120 US a ton, and it had a little bit more of a win. There we go. And then this is now when the iron ore price started to really come down. And this is when I started to see prices in that space from investors really halve, and rents halve with it as well.
And don't get me wrong, we're buying as investors in the Perth market. There's still solid growth to come, but we're just not a share market. It's not a share that you can trade. If you've got long-term fundamentals and good solid areas, you're going to be absolutely fine. If you're more of an aggressive flipper, someone that wants to buy in and buy out of markets, then there's considerations from that side of things. But it's super interesting to watch these property markets. I love doing this chart because it just really sets. I've probably watched it, 60 times, just because it kind of makes you feel like, oh right, we're a part of a cycle, we're a part of a bigger thing that happens, and you can see that different times work for different markets and different things happen. So I think this ends at 2019. And Melbourne and Sydney are on top. Well, Melbourne and Sydney's still on top right now, but it does show you what can happen.
Yeah, and remember I said Perth was the most volatile in the research and Adelaide was the least. I mean, you rerun that thing. Adelaide just does its merry little thing. It's only in this last year that we've seen such a huge jump.
It doesn't really move a lot, does it? It's just kind of sat at that 470s for a very long time.
It's got all the wit and charm of a urinal.
Great chart. I love that chart, Joe. I think you've showed me about 2 or 3 times that one, mate. It's brilliant.
Sorry. Yeah, so I'll stop boring you with my charts. Actually, I'll never bore Mike with a chart. So there's a question that's popped up here. Boys, can we address the cash flow equation? If we're borrowing at an 80% cash flow is negative, more generally, what does the LVR need to be in today's climate to have a neutral cash flow?
I've done this equation about 30 times with clients. So I've actually got this pretty much at the back of my head. If you're buying a property with a 5.5% rental return, which one would argue to say is quite strong in this particular market, and a 6.5% interest rate, and let's say the purchase price was 600 grand, because I've done this modeled this on this number, your leverage would need to be about 67.5% to become generally cash flow positive.
Pre-tax?
That's pre-tax.
Pre-tax, yep.
So that's before the magic happens at MCG with the lovely quantity survey tax depreciation reports that you guys provide to bring it into a significantly better position post-tax. But I've done those numbers, and it's only at the moment where, again, yields are so low, interest rates majority at 6.5%. That's where you need to have roughly that 70% LVR to get it into a position where it's breaking even. Those numbers will change depending on prices and holding costs. Some areas have far substantially higher holding costs, and it could be due to repairs and maintenance, age of the property, a lot of metrics that go into it. But to draw a line in the sand on those numbers, about 70% gets you into a more neutral cash flow.
And that's probably the shift that I would like to see property investors making in 2025, is not chasing the yield. Chasing the yield is going to be a bit of a fool's errand beyond 2025. It is going to be just chasing the yield. You need to focus on capital growth, and where is the capital growth going to give you the most amount of bang for your buck? Yield is fantastic. Like, I hate putting on my website 6.5. We were buying at 6.5% because that was the best market for capital growth and the balance of cash flow. Those markets now are no longer the cases, and those numbers no longer exist. And that's just the reality. So our goal as investors is to buy the best property in the best location at the best price for our buyer brief. And it used to be a 5-6% yield would give you the capital growth. And we've seen that in the Townsvilles, we've seen that in the WAs, but that is no longer the case. From a net overall return on investment, you are going to have to focus more so on a 3.8 to a 4.5% yield. That's the spot of where I see capital growth occurring in the next, let's say, 3 years.
And if people want yield, Joe, you've got to create yield. The best investors that I've seen out there, I've never seen them buy property at a 6, 7, 8, 9, 10% yield. Steve Police is scratching his head at the moment because he's probably saying, I've bought many properties with net 6s and net 7s, and he did when those numbers were there. But a lot of the best investors that I've seen create yield, and they'll create yield through granny flats or through adding fourth bedrooms or changing the dynamics of how they're renting the property. I've seen Steve and a lot of his clients create a lot of yield in commercial property through adding mezzanines, spending 70, 80 grand on mezzanines and increasing the net rental yield for that property by 1.5%, 2%, taking it to a net 7% net yield. So I think if you really want to chase yield, first focus, as Joe said, on capital growth. So get that fundamental of the property right, and then create that yield. And that's where you can probably get the best of both worlds. And then get someone like Mike to improve that net yield even better by getting the depreciation schedule on your granny flat, which when you gross up that yield with the depreciation benefit you're receiving, that is sugar on your cake. Selling it for you, mate.
Thank you.
Yeah, well, this is one of the slides that I wanted to bring up because I've got a stupid question, and I'm happy to be the dumbest person in the room. Definitely in this room.
I need 10 minutes off.
Always here to make me feel good. This is what you've pulled up from depreciation deductions. Are some states just better for deductions than others? Mike, what are we looking at here?
Great question, Joe. Some states are, I would say, fundamentally better for deductions, like ACT. Think about it. It's a tiny little state that didn't exist until we invented it, and then we filled it full of highly paid public servants, and we built heaps of apartment complexes and towers, and nothing is really, really old, and everything that was old is fairly well gentrified because it costs $1 billion to get in there. So, I mean, you can probably see that quite clearly in the ACD data, because if you think about the properties that are the best for depreciation deductions, typically they will be units rather than houses. If they're units, they'd be typically in bigger complexes rather than smaller. If they are houses, they typically would be newer rather than older. But if they are older, they'd be substantially renovated. So yeah, sometimes just because of the peculiarity of the types of dwellings that people build in different states, that can have a bit of an influence. But I must use my little catchphrase that's depreciation is a bonus, not a strategy. So no one should be looking at, oh, I see there's heaps of opportunity in ACT for depreciation deductions. Maybe I'm going to start looking there for my next investment property. No, like that's a bad idea. The difference between a good investment property and a bad investment property is far wider than, say, $20,000 a year worth of depreciation deductions. So no one should ever really work that way.
Agreed.
Yeah. Do you see that a lot, Jeremy, from your side of things? Because you're the accountant, right? People are like, oh my gosh, my tax bill, I have to pay $100. I don't even talk to me about tax. I just say, Jeremy, what's the number, and I'll pay it. But just don't tell me what that. Just say, just tap the card. I don't want to know. But I do want to reduce.
Take it out of the mattress.
Possible, but it's definitely not a driver for my decisions.
No, I think people are getting a lot wiser and a lot smarter. Years and years ago, when Mike was running around those traps at that stage, there was a lot of these sleek, well-oiled, greasy seminars that would be selling a huge amount and flogging off a huge amount of properties off the plan under the guise of a substantial amount of tax benefit that you receive. Pay your home off with tens of thousands of dollars worth of the ATO's money. And I think people just got really, really smart once they bought these properties and they realized that they got a really big refund. It cost them an arm and a leg to hold the property, and it didn't grow for 10 years. Yeah. So there's enough of those stories now running around the trap. There's enough professionals in the industry, Joe, like yourself and many other property professionals, that are educating clients on, brand new or off the plan properties from an investment perspective. Go nuts, go hard if you want to buy it for your owner occupier and you love the area and it's new and flashy, that's great. But from an investment perspective, and there's lots of supply coming onto the market, it's not going to be ideal. So those well-oiled, greasy seminars, Joe, kind of died off in the Banking Royal Commission and probably at COVID time, because that's how it's much easier to try to sell someone something that's an ugly duck when you're in front of them and you can put the pressure on as a salesman. People stopped going to those things and hence people got smarter.
It's a sad state of affairs, but whenever people talk about depreciation from a sales perspective, i.e. buy this apartment, buy this house and land package because of great depreciation, it's almost certainly a bad investment. If they have to resort to depreciation to sell the bloody thing, it doesn't stand on its own. Now, I'm not saying like there's anything wrong with depreciation. I've dedicated the vast majority of my life to it, but I'm just sort of saying, get what's there. Don't go and chase the maximum depreciation. Everyone should claim their entitlements. And, we've got our own data that says that there's about $2.88 billion worth of unclaimed deductions floating out in the ether from residential property investors. So you definitely need to do it. But yeah, if they're sort of saying buy this because of the deductions, that's normally a clue that it's not a good investment.
So you're telling me there's nearly $900 million of unclaimed tax dollars that are out there that's sitting in the ATO's coffers?
Well, it's 2.88 billion the first time that we crunched that number. So
of deductions, which would mean that the cash benefit would be nearly $1 billion. Guys, get out there and do your damn depreciation schedule.
Yeah, I was just thinking, I was looking at the Oz property portfolio and I'm like, we have not done any depreciation on any of the assets that we're going.
$1 billion of cash out there floating in the system.
I did poke you the other day, Joe. I mean, you can lead a horse to water, but, you need to send me this Excel spreadsheet where you analyze the capital growth and, let me have a look and get some money back for these people, honestly. Honestly.
Brendan's jumping in the comments here. Magic Mike, your advice has served me well. I've carpeted my whole IP, kitchen, bathroom walls, everything. Worked a treat for depreciation. So you can.
I wonder who that is.
That people to stop installing your staff members into our thing.
It won't.
He's
I mean,
not.
I'm in the office and I'm the only one, so it's not going to be one of them. I mean, that's a bit of an in joke where I was talking about floor coverings aren't created equal. So the effective life of carpet is 8 years. It used to be 10, now it's 8. So if you're using the diminishing value method, as Jeremy will know, it's 200 divided by the effective life gives you the rate of depreciation. So it's 25% for carpet. Whereas if it's, say, concrete or timber floorboards or tiles, it's 2.5%. So I say, like, if you don't care either way and you're thinking tiles or carpet, carpet all the way. In fact, carpet everywhere. In fact, carpet the kitchen, carpet the bathroom. You know, when you go to the toilet and you miss, I mean, I'm in an office full of estimators and you wouldn't believe the estimating errors that we have in the bathroom. You know, let the carpet soak that up and just think of the deductions that you're getting. Obviously, it's gross, ridiculous, and weird, but at least people remember that. So thank you, whoever that was.
I heard Timu were getting into the kitchen game, Mike. So that might test you a little bit of the average useful life of a Timu kitchen.
It's about 13 seconds, I'd say.
I did buy some things on Timu, and it lasted probably as long as I opened up the little packet they came in, and then it fell out broken.
Yeah, they do have a Timu house like living now. I've seen ads on
Timu living. It's not living as you'd wish.
Anyone that's got any questions, guys? There has not been too many questions on this session. I think you guys, we've come up with a question. There's been an answer straight after it. So if anyone has some burning questions, we would love to bring them up online so you guys can get some answers to some of the questions that you've got. There was a question here regarding interest rates are set to decline, further boosting consumer sentiment. Demand will continue to favor affordability. Rental growth is likely to continue slowing as affordability pressures mount. Okay, that was more of a statement than a question.
Yeah. And I agree with it because it seems to be exactly what I said. So whoever that is, they're obviously very clever and good looking.
Yeah, was this actually?
I wonder what the butt is. Maybe the butt's where I get a punch in the face, Joe.
Yeah, I'm just going to have a look for that exact comment and find what the butt was, because there is a butt at the end of that question.
Yeah. So one thing I will say that people need to also understand is the counterproductive movement of rates coming down versus slowing rents. This is very important. If we've got rents which are slowing down, the pace at which they're increasing, slowing down, or in fact they're even reducing. And I can definitely say, and in my own portfolio, with the properties that I have, I've actually seen my rents stop over the last 6 months. Forget about trying to increase it. No one's going to do it. In fact, a couple of vacancies I've had to reduce my rents. Now, if we've got rates coming down and rents stagnating or slightly coming backwards, the costs of holding that property are only going to go up. Council rates are indexed and increase 4 or 5%. If you're like me and who's got some properties in the Central Coast, they've increased like 20%. Water rates are increasing. Insurance, every single one of my insurances, I fight with the insurance provider. I won't say it here live on this, but I fight because I see the increase of 25, 26, 27%. I pick up the phone, I scream, I yell and abuse, and it comes down by 10%. So if you've got
Can I get the script for that?
Oh, mate, you don't want to hear the expletives on that other side.
I'm fine with it. If it cuts 10%, I'll say whatever.
It cuts 10%, and when you've got the volume of properties I've got, it's a lot of money. But you know, you got slower increase in rents or stagnating rents. Yes, you've got rates coming down, but if the costs of the properties are continuing to increase, rates coming down helps, but actually it's lost. The benefit is lost in the rents reducing and the cost of the property increasing due to inflation. So you also need to take that into account, that the real movements of rates coming down has to also be counteracted by, you know, if you've got rents going up, then that spread, that gap between rents and rates, it improves the position of the property. So that's also something people need to take into account. It's not all about just rates coming down, because yes, it's a large portion of your cost of the property, but it's also the other thing that fuels your property, which is the rental income and the costs associated with holding that.
Okay. So Keith has jumped on here. You guys understand taxation will end. So I think that made me realize we should not end on taxation, because I don't know why I decided to get an accountant and a tax depreciation person on here. So I wanted to go, what are our Mike, you have one final slide on here that I think is worthwhile to present to people. And I want to get your guys' predictions for capital growth in Australia, but we've got total listings. Do you think the Australian property market will follow the listings, Mike?
Well, that last slide, I think, is distressed listings. The reason why I put that up there, because I was looking at this in the market update for the Property Trio podcast that we do once a month. And so there's new listings, there's listing volumes generally, and there's distressed listings. So amazing to watch Perth, Perth, Adelaide, and Brisbane really in concert. Like really, anytime that you saw a contracting supply of listings, it correlated with property price growth. We actually saw like quite a lot of stock come onto the market in Perth in the last little while, but if you look at it over the long term, it's still historically quite low, whereas we've got further stock constraints in Adelaide, and I think Brisbane is there or thereabouts. But I think listings, when we talk about supply and demand, I think in 2024, we've been sort of led by politicians to think supply is building new properties. And sure, that is a type of supply. But I think even more important for us to consider is the supply of listings. So, if we've got a tight market where people aren't selling and there is, a reasonable level of demand, then you're just seeing more competition in the marketplace. So, yeah, looking at the old listings greater than 180 days, if you look at, say, Perth, like it has a yearly change of, what is it, negative 50%. I mean, that kind of says that the properties that stick in a market that isn't red hot are selling, right? The ugly duckling properties is another way of putting it. I mean, that just goes to show how much heat there is in the market when you see such a huge contraction of these aged listings. They're old listings, possibly because they're overpriced, but more likely because they're undesirable, but they were getting snapped up at the peak of the market. And to some extent, they are still getting snapped up. And look at the red figures: Brisbane, Perth, Adelaide. What do we know about 2024? Those were the three markets that kicked ass.
Yeah. And the interesting thing is, before Brisbane, Perth, and Adelaide started to kick off, the conversation that we would be having in 2020 and 2021, looking at the data, would be very different. Like, we wouldn't be exactly. They were the worst performing. So when we say, it's hard as an investor to look at these charts and be like, oh, well, this one's done so well, we need to be buying the market that's done so well. Not necessarily. There's a lot more to it, and you need to be contrarian as an investor, because that's where the opportunities lie. It is choosing those markets that have the most amount of, for me, it's the supply story. Like, you can't change the supply story, and the demand is a big part of it. Obviously, the supply and the demand, but go to where the markets have the least amount of supply, and I think you would do quite well.
Yeah, I've always tried to.
Capital growth forecast, Jeremy. Sorry, I cut you off there as well. What were you going to say?
That's right. No, I think capital growth forecast, I still believe there's going to be lingering capital growth in those three states that you've mentioned, Joe, to be very fair. And those are, I call that the last 20% of the money coming into the market. So they're the last people that have waited on the fence for so long. They've heard all their friends get rich by buying in those particular areas. And it sounds terrible, I'm sorry, but that's generally the dumb money. And that's that last peak before the storm. I believe from a value perspective, and I put my money where my mouth is, and what I've recently done over the last 6 months is I still truly believe from a Victorian point of view. Again, a lot of policies have been implemented by, I believe, a Labor government that's going to be removed very soon, which will change the dynamics of that state, and has been a very Labor-dominated state by memory for the last 30, 35 years. So I think there's time for a change there, and that will bring in some fresh air. And without a doubt, when the property market's doing well, the states are doing well. So I believe that probably maybe, I don't know if there's a bit more bottom to go in Victoria, but I can tell you now, the agents that I'm speaking with and the offers that I'm making on properties there, 12 months ago, I was getting called back 50 times to take the property for the first offer that I gave, and actually backed out many times. Now I'm calling back the agents to ask them where my offer's sitting at the moment, and they're telling me to I've got to really increase it before I can have another shot. So again, Joe, probably ought to say that the areas I'm looking at in Victoria are the more affordable end, that 650 to 750 bracket. I haven't really gone into that more expensive bracket just yet, but that little gap there is really starting to get quite competitive, and it's getting to the point where I've got to revisit and maybe try to up my prices a bit more to get out of that space where there's a lot of competition. So that's where I think there will be capital growth to come. I don't think I can pick the bottom or when it's starting to rise, but those three states I still feel will have a lingering amount of capital growth.
Yeah.
Getting ready for new states to take over.
And you're not buying for a year. You're not buying for 2 years. You should be minimum thinking for 5 years. Ride the cycle while you can, and 10 years. There's so many different ways to do property investing, but it's definitely not a year decision.
Victoria is as a state, it's a basket case economically, right? So we really need that to be turned around. New government might go a long way to doing that, but when we're looking at an interest bill of $1 billion a month, I mean, it's dire straits in Victoria. So yeah, anyone that's buying with the idea that it's going to do 20% in 2025, it's not to say it's not possible, but I would be definitely considering a longer time frame if you're betting your sheep station on it.
Yeah, well, it's the funny thing as well is, like, you could buy in a hot market right now, but if you buy in a bottomed out market, or a market that's it's kind of slowly coming up, like Jeremy, you're talking about with Victoria, and you can negotiate 5%, 10%. That's 5-10% to your bottom line from the portfolio standpoint. So there are pros and cons. You buy in a hot market, it's incredible. You will get an instant go, but you've got to be buying at and above market value. But if you can buy in an area that hasn't got that competition, that allows you to negotiate better to get your 10% up.
I'm going to give you guys a fun fact. When I was buying in WA in 2019, I was getting called the biggest D head in the world, which is fine. I copped it. But the properties that I bought there had all been on the market for longer than 12 months. That's an interesting fact. And that was 2019, when everyone was still rocking and rolling back in Sydney and some other areas. And I was getting some really weird looks and comments from people saying that I lost my marbles. But those properties that I purchased in WA were on the market for longer than 365 days. And I always said to myself, from WA's perspective, it would be transactional for me, number one, but number two, I'm prepared to hold these for 5 or 6 years before I think I'll see growth.
Yeah.
So that was my mindset going into that area.
Drinks are on you, Jez. Just putting that out there.
And on that note,
Well
I think
done.
we should wrap this up, guys. This has been an unreal session. Mike Mortlock from MCG Quantity Surveying, thank you very much for the incredible slideshow. How can people get in touch with you, and how do we get our Oz property portfolio depreciated?
Yeah, well, I mean, it starts with the feasibility, and that's just having a look at the property, which we can do online, and give you an idea of the potential deductions. Of course, to do the report, we need to make sure it's worthwhile, because we need to go and inspect the thing. So yeah, happy to help you and anyone else with that. I'm of course part of the forum. I've done a few lives. I've done a tax special, which I think has been purposely hidden in the archives. But yeah, you can find me in the Facebook forum and on Facebook and at mcgqs.com.au.
Yeah,
I don't think they've been hidden. I don't think they've been hidden in the archives, Mike. I just think that you've changed your look so many times, my dear friend.
That's true. I like to keep people guessing. I get fat, I get skinny. I had a shaved head like some sort of paramilitary fella for a good decade. No facial hair. It just does seem like I'm on some sort of ASIO watch list, and I've just got to stay in the shadows.
Staying in the shadows. Jeremy, thank you for your insights as well at Pradium Partners. How do people learn more about you and get more Jeremy in their life as well?
I'll be floating around in your comments, I'm sure, many times over the 2025 year. And you can visit us at pradingpartners.com.au.
Love it. I'll put both of those companies in the little show notes comment thing here. That's what Jeff usually does. So I will do that now. But yeah, no, insightful. I'm excited for 2025. It's not a throw a dart at the map situation here anymore. But I hope we've given you some insights into what you can do. And if you guys need anything, reach out and rock and roll. Let's make it happen.
Cheers,
Everyone,
guys. Pleasure.
catch us. Stay well.